Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into ONEOK Inc., trading under the ticker OKE. This deep dive is about the unsexy, indispensable infrastructure that makes the entire U.S. energy system possible, the massive pipes and, the long-term contracts. Our central thesis is clear. OKE is betting its indispensable 60,000-mile infrastructure network, structurally fortified by the Magellan Midstream acquisition and 90% fee-based revenue, will drive a low-risk 8–10% annualized total return and reward shareholders for patiently waiting for the massive AI industrial demand catalyst to accelerate its bottom line.
That is the perfect frame for OKE. It really is the quiet artery of U.S. energy.
The quiet artery, I like that.
Yeah, because when people think energy, they picture rigs drilling for oil. It's the essential infrastructure that collects a toll on every molecule after it's already flowing.
So a completely different business model.
Exactly. It's all about logistics and stability.
And the power of that model lies in what you call its moat. It's not built on some innovative patent or the latest tech hype. It's just sheer, immutable physical scale.
Right. You can't just decide to build 60,000 miles of integrated pipeline network tomorrow.
Not a chance.
That scale translates into an operational integration that, it takes decades and billions of dollars to even attempt to replicate. When we talk about a physical moat, we mean geography and time.
So it's literally buried treasure.
It is. It's buried beneath the ground. OKE controls these key routes for natural gas liquids and refined products all across the mid-continent and the Gulf Coast. If you're a producer, you're basically tied into their system.
To truly appreciate the scale here, let's break down what they actually move and what drives the most revenue. Looking at the 2025 adjusted EBITDA guidance, the company is built on 4 critical pillars.
And the structure is very telling. The largest segment, the one with the highest margins, is natural gas liquids, or NGLs. That drives about 37% of their projected 2025 adjusted EBITDA.
And NGLs, that's high-value stuff, right?
Yeah. Very high-value transport. We're talking about things like ethane, which is crucial for plastics and petrochemicals, and propane.
Okay, so NGLs are the engine. What's next in line?
Next up, you have the operational start point. Gathering and processing, that accounts for about 28%.
The feeder system.
Exactly, the feeder system.
Yeah.
That's where they take the raw gas straight from the wellhead and separate it into its marketable parts, including those valuable NGLs. It's a make-or-break operational step.
So that covers the collection and refinement, then we pivot to the other 2 segments.
Right, at 27%, so almost equal to gathering and processing, is refined products and crude. And this is the piece that fundamentally changed the company.
Okay, and the last one.
And finally, you have natural gas pipelines. That rounds out the structure, contributing about 8%.
Only 8%. But that's the one we need to keep an eye on for the future catalyst, right?
Precisely. It's small today, but it's absolutely crucial to the growth story.
Let's focus on that massive shift you mentioned, the refined products segment. That came entirely from the absolute game changer in 2023.
Yeah.
That pivotal $18.8 billion acquisition of Magellan Midstream.
It was a monster acquisition. It just instantly recast OKE as a multi-commodity leader.
So before Magellan, what were they?
Before Magellan, OKE was already a giant, but mostly dominant in NGLs. Magellan brought in all these critical refined product pipelines, gasoline, diesel, jet fuel, with, superior geographic reach, especially into the Northeast and Southeast markets.
And why is that specific diversification so strategically important?
It's all about smoothing out the cyclicality. NGL demand can sometimes swing with global industrial cycles.
Right.
But demand for gasoline, diesel, and jet fuel, the core of Magellan's assets, that's much more resilient. It's consumer-driven. Merging them sort of weatherproofs the whole portfolio.
And the resulting market scale is just staggering. This isn't a niche player anymore.
Not at all. We're talking about true logistical dominance. Post-merger, OKE now supplies over half of the entire U.S. petrochemical NGL needs.
Over half.
Think about that. Half of the raw material for American plastics and manufacturing is running through their pipes.
That is just incredible leverage. And what about on the refined product side?
Their network now touches around half of America's total refining capacity. It gives them immense pricing power.
Which brings us right to that core stability. The real asymmetry, as our sources describe it, lies in that contractual leverage. We're talking about a revenue structure that is, around 90% fee-based?
That 90% is the company's armor. It's how they shield themselves from, oil price chaos.
Because they're not speculating on the price.
No. Midstream companies like OKE, they just charge a toll for moving the commodity. It doesn't matter if that barrel of oil sells for $100 or $50.
The producer takes on that risk, while OKE collects predictable cash flow based on the volume moving through the pipe.
It's proven. OK has this phenomenal track record. 11 consecutive years of adjusted EBITDA growth. That's from 2013 right up through the 2024 projections.
In a sector famous for volatility, that's wild.
It is highly unusual. It speaks directly to the quality of their contracts.
And for income investors, that dividend is a powerful anchor. You are, in effect, being paid to wait.
Absolutely. The dividend is currently yielding about 6% annually, with a quarterly payout of $1.03 per share. That yield is pretty secure, backed by that predictable fee-based cash flow.
So for a certain kind of investor, that 6% alone is a good enough reason to be in.
It can be. It's a solid core asset, and it funds the patience you need while they execute this huge, complex integration.
Speaking of execution, let's talk about that. Weaving together two giants like OKE and Magellan is a monumental task. How did they look in the most recent snapshot from Q3 2025?
The recent financials confirm really solid sequential growth, so the integration is definitely moving forward.
What do the numbers say?
Let's look at Q3 over Q2. Net income hit $940 million, which was a very healthy 10% sequential increase.
Okay.
And adjusted EBITDA, that key metric for cash flow, came in at $2.12 billion. That's a strong 7% sequential jump.
And that growth is what's giving management confidence because they affirmed their full-year guidance, right?
They did. They confirmed the 2025 adjusted EBITDA guidance range of $8.0 billion to $8.45 billion. That kind of execution, it really stabilizes investor confidence.
And it's not just about the earnings, it's also about balance sheet discipline.
Hugely important, especially after an $18.8 billion purchase. They are actively managing that leverage.
What are they doing specifically on the debt side?
In Q3 2025 alone, they retired over $500 million in senior notes.
A clear signal.
A very clear signal that they're focused on deleveraging. This keeps them squarely on track to approach their critical 3.5x long-term leverage target in the fourth quarter of 2026.
And just for our listeners, why is that 3.5x number so important?
It's a measure of safety, really. Financial flexibility.
Oh.
A lower number means the company has more breathing room, it can weather economic shocks better, and it has a lower cost of borrowing. Reaching 3.5x is a sign of institutional discipline.
So the foundation is stable, finances are disciplined. Now let's talk about where the real growth comes from. First up is synergy acceleration. It sounds like they are crushing those targets.
They really are. They're far ahead of schedule. The 2025 guidance already includes another $250 million of incremental synergy-related adjusted EBITDA. But the bigger story is that the total realized synergies since the deal closed are already approaching $500 million.
$500 million.
Yeah.
How do you find that much synergy just by combining pipes?
Well, it's smart engineering and logistics. It's things like optimizing pipeline routes, consolidating redundant operations, and critically cross-selling capacity.
So you can offer more services to existing customers.
Exactly. If a customer was just using one system, now you can offer to move a different commodity on the other system. And management noted that most of these are totally within their control, which is key.
That's the internal growth. Now for the really big one, the emerging external catalyst that could supercharge that smaller natural gas pipeline segment, AI.
This is where OK's physical location becomes incredibly valuable.
Because data centers are power hogs.
They require exponential amounts of power. Utility grids often can't keep up, so these huge data campuses are increasingly looking to build near-stable, low-cost natural gas pipelines for their own on-site electric generation.
And OKE happens to be right where that's happening.
Precisely. Their key assets are in Oklahoma, Texas, and Louisiana regions, seeing immense growth in this kind of industrial power demand.
And they're already seeing interest.
Oh, yeah. Management has confirmed they are in active discussions with well over 30 different projects related to potential AI-driven data centers and other large industrial facilities.
Can we put a number on that potential demand?
It's enormous. It represents over 4 BCFD of potential demand.
4 BCFD. Put that in context for us.
It's a massive volume. If even a fraction of that materializes, it provides a meaningful, high-margin tailwind for what is currently their smallest segment. It's a surprising growth path driven by electrification.
So let's synthesize the final verdict. We've got this defensive asset with high stability from the 90% fee-based revenue, targeting an 8 to 10% total return. But it also has this high upside call option with the AI catalyst. Does that make it a core low-risk asset?
Well, we absolutely have to revisit the structural risks first.
Okay, lay them out.
First, while the fee structure is robust, there is the risk of lagged commodity volatility. If oil and gas prices crash for a long time, producers eventually stop drilling.
And that would eventually hit OKE's volumes down the line.
Exactly. When existing contracts roll off, they might have fewer customers or smaller volumes to contract. It's a deferred risk, but it's real.
And the other risk, the internal machinery itself.
That's the second major point, execution risk. We talked about $500 million in synergies, which is fantastic, but weaving together these massive complex assets, Magellan, EnLink, Medallion, it's never guaranteed. If integration stalls, those expected synergies can just, evaporate.
Okay, and finally, what about market perception? Is this some kind of hidden gem?
No, explicitly not. The company is highly visible. Institutional ownership is over 69%. The market has already priced in its quality and stability.
So no huge valuation surprise waiting around the corner.
Unlikely. And we noted one last piece of data that gives us pause. A low insider alignment score.
A 3 out of 10.
Right. And that suggests that even management, the people who know the business best, see the immediate upside potential as somewhat capped. They aren't making huge personal bets on the stock's near-term growth.
Which leads us directly to the final analyst conclusion from our source material.
Yes.
Despite the undeniable quality and stability, the analyst determined that the stock did not meet the criteria for a hidden gem with explosive growth potential and explicitly stated, "I am not buying."
Right. The upside, while solid, just wasn't compelling enough to justify an aggressive investment right now, given the visibility and the more modest immediate growth profile. The final takeaway for you is that OKE offers this utility-like stability that's driven by the fee-based model and the utter indispensability of its physical infrastructure. It ensures steady compounding, a robust dividend, but you have to recognize that stability trades at a premium. And that massive AI catalyst, it's a future event, not a present guarantee.
Risk defined. Portfolio protected.